Hey everyone, welcome back to another dividend investing video. We are here for dividend investors, especially value-minded dividend growth investors who are building up their portfolios. Now when I'm looking at potential dividend investments, I want to be confident that if I'm putting my money in a company over the next decade or plus, that I can count that they're going to continue paying this dividend and growing it at a rate that hopefully beats inflation. The latest numbers suggest inflation might be slowing. Good thing, because in 2023 dividend growth is also slowing across the board. So I've identified a few stocks that have been raising this dividend at double-digit rates, and they are at valuations that I think are appealing. So I'll go over these real briefly. Let's talk dividend growth investing. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. We're going to just dive into these without delay, but briefly let me give you some criteria to justify why I like these stocks right now. Okay, the goal here is finding stocks I think are cheap or undervalued that feature high dividend growth and growing free cash flow. So what I want to see is a few things. I want a PE below the 5-year average. In the case of REITs, substitute PE with price to adjusted funds from operations. Second, I want a dividend yield that's above its 5-year average. I don't believe in chasing dividend yield, but I would like to lock the yield in at an ideal starting yield for that particular stock relative to itself. The dividend safety score of 80 plus at Simply Safe Dividends. I'm following their methodology as I pay a hefty price for their subscription. And I also want a 5-year dividend growth rate of 10% plus. As I mentioned in my latest video on SCHD dividend growth, the overall trend is, well, it's slowing. So let's try to find the companies that are still managing to continue to grow this dividend at a nice rate. Now, having all 4 of these does not guarantee that a stock is a good buy, but for me it sets a baseline to go into further research. So let's get into these. The first stock we're going to go over is Automatic Data Processing, ticker ADP. Now, ADP provides human capital management solutions to employers, professional organizations with cloud-based platforms, and human resource outsourcing solutions. They do payroll, benefits admin, employee management stuff, and they've been at this since 1949. Year-to-date, shares of ADP are down about 10%, and shares are not too far off their 52-week low. ADP has been a long-term winner from a total return perspective. The company has returned 381% to shareholders over the last decade. Not too shabby when compared to the 230% total return of the S&P 500. The PE ratio is 13% below the 5-year average at 24.5, meeting my first criteria for selection. ADP does trade at a premium for sure, but right now it's as cheap as it's been since early 2020. The dividend yield is 16% above its 5-year average at 2.34%, meeting my second criteria. This is a good starting yield for ADP from a dividend yield theory perspective. Now, Simply Safe Dividends decides a very safe dividend safety score of 97, meeting my third criteria. Payout ratios look healthy. 57% of forward earnings, 41% of forward free cash flow. And that huge free cash flow growth shown here is very important for future dividend growth. And ADP's average annual dividend growth over the last 5 years is at 13%, meeting our final criteria. The last raise announced back in November was at 20%. And even more impressive is the company's just 2 years shy of hitting Dividend King status with 48 years of dividend growth. The dividend is paid out quarterly in a payment of $1.25 per share in the months of January, April, July, and October, for a total annual payout of $5 per share. There's so much to like here. Like these 2 graphs, the left displays the reduction of outstanding shares over the last 10 years, and the right illustrates the increase of revenue, both impressive. They also sport a high return on invested capital, 60% over the last 12 months. They feature low debt. They increase their dividends during recessions. I'm looking for something negative here, guys, but I got nothing. The next stock I'm highlighting that meets my criteria is Elevance Health, ticker ELV. Okay? Elevance operates as a health benefits company, formerly known as Anthem Inc. The Elevance name has only been in effect for the past year, but they've been around since 1944, connecting consumers to healthcare support and resources they need to live healthier lives. Year-to-date, shares of Elevance Health are down 10%, much like the rest of this industry that's been in the dumps in 2023. The last 10 years, however, tell a much different story. Shares of Elevance have a total return of 553% over the last year, which is close to double what the broader market did. And this one has been a winner. Let's check it against our criteria. Elevance sports a PE ratio of 13.4, which is 8% discount to the 5-year average, meeting my first criteria. Shares are yielding 1.31%, which is 13% above the 5-year average of 1.16%, meeting my second criteria for the video. Now, Simply Safe Dividends gives ELV the highest safety score possible at 99, rating it very safe. And the payout ratios are 18% from both forward earnings and forward free cash flow, looking fantastic. See this free cash flow graph over the last decade? Without this, it's pretty hard to keep growing your dividend. Elevance's average dividend growth annually over the last 5 years has been 14%, meeting my final criteria for the list. And the latest raise in January was announced at 16%. The dividend has been growing for 11 years consecutively. Elevance is a March, June, September, and December payer. They pay out $1.48 per quarter for a total annual payout of $5.92 per share. Just like with ADP, you got two graphs here. The left is outstanding shares, which we want to see declining, and the right is rising revenues, and we want to see that increasing. These are both huge green flags for potential investment. They also have no long-term debt. Their cash on hand exceeds their debt. I think there's some upside potential here as well, which you want to see when you're talking about a lower yielder like this. Average analysts put a price target of ELV at 24% higher than where it sits today. So this is one that I'd personally like to own, but I'm quite heavy in healthcare right now. I just don't really have the room or capacity, but I think it's a screaming buy. Maybe someday. The next company on my list that meets the criteria is EOG Resources, ticker EOG. EOG is a developer and producer of crude oil and natural gas, primarily producing in New Mexico, Texas, and Trinidad and Tobago. They were formed in 1999 after the collapse of Enron Oil and Gas. They were kind of separated from that. Today they sit at a $62.5 billion market cap. Year to date, shares are down 13%. Almost 13.5%. Shares are trading closer to the 52-week low than it is the 52-week high. Now, over the last 10 years, compared to the S&P 500, the total return has underperformed, making EOG the only one of these out of the four that hasn't beat the broader market in the last 10 years. But let's check it against our criteria. Shares of EOG are trading at a steep discount to the 5-year average with a PE of 9.2, meeting our first criteria. It's also at a discount to the energy sector. As a whole, the sector is in the dumps for 2023, so that could mean long-term opportunity if you are long-term minded and don't mind a little bit of short-term volatility. Now, from a dividend yield perspective, EOG is sitting 30% above its 5-year average, meeting our second criteria. Shares are now yielding just over 3%. Simply Safe Dividends gives EOG a safety score of 82 for their dividend, meeting our third criteria. They rate it, this dividend is safer than megacap ExxonMobil even. The dividend makes up 28% of forward earnings and 40% of forward free cash flow, so looks solid. They'll be able to keep paying this dividend. Now, EOG boasts the highest 5-year dividend growth rate out of this group at 36% on average over the last 5 years, easily meeting that criteria. The dividend has been growing for 5 consecutive years, and we are at 31 years without a dividend cut. EOG is a January, April, July, October quarterly payer, and their qualified dividend payment of 82.5 cents brings their total annual payout to $3.30. There's also a history of making some special dividend payments. Looks like it's happened over the last 4 quarters, but not this recent quarter here. Now, of course, investing in this kind of company, you have to be aware of the cyclicality of their industry. The price of natural gas is weakening due to oversupply, and this could pose some short-term issues. Analysts see a lot of upside, though, with EOG, with the average price target at 32% upside from current levels. So I think EOG definitely deserves some consideration if you're comfortable investing in this industry. Not all investors like the energy sector. It's a little, let's just say, unique. So the next stock I'm talking about right now is Home Depot, ticker HD. Home Depot is in the consumer discretionary sector and part of the home improvement retail industry. They sell various building materials, home improvement products, lawn and garden products, and more. In addition, they offer installation services on most home improvement related jobs and tasks. Year to date, shares of Home Depot are down about 5%, but from a total return perspective over the last 10 years, investors in Home Depot have been sitting pretty, with a total return of 411%. That's a substantial improvement over the broader market, which returned 230% over the same time frame. With a PE ratio of 19.9, this sits below the 5-year average of 20.6, meeting my first criteria for selection. The Home Depot's dividend today is 18% above its 5-year average, meeting my second criteria, and shares are yielding 2.78%. This is more than a point higher than the broader market as well. The Simply Safe Dividends provides a dividend safety score of 87, meeting my third criteria. Payout ratios are 55% of forward earnings, 51% of forward free cash flow, nothing concerning there. Free cash flow trend is in an upward trend over the last decade. Growing free cash flow allows for a growing dividend, and Home Depot sports a 5-year dividend growth rate of 16% per year on average, meeting our final criteria. Its latest increase back in February when they announced a 10% raise. Pretty awesome. That's 14 years of consecutive dividend raises, 35 years without a dividend cut. Home Depot pays out that quarterly dividend in the months of March, June, September, and December, paying out $2.09 per share for a total annual payout of $8.36. These two graphs side by side, the first one shows the steadily declining share count over the last decade, and the one on the right illustrating its revenue growth. Of course, with any stock there are risks. In the short term, I think the state of the housing market could add some pressure to their margins. Wall Street analysts assign an average price target of $317.27, and this represents 5.47% upside from where things are today. So if you're looking for companies that feature high dividend growth, that look attractively valued, I hope I gave you some food for thought here. And of course, I suggest doing further due diligence, and as always, know the risks of investing in the stock market. Now, in this next video, I discuss what's been going on with SCHD. Its dividend growth does appear to be maybe cooling somewhat with its latest payment, but I dig into the facts and I show you why I'm still buying into this ETF, all right? Now, thanks so much for sticking around, and until next time, keep investing.